Hello and welcome to BQ Prime. You're watching IPO Adda, and the company in focus today is Rishabh Instruments. Uh, it's a company which is involved in the global energy solutions business. And joining me is Mr. Narendra Goliya, who is the chairman and managing director, and Mr. Dineshkumar Musalekar, who is the group CEO of the company. Gentlemen, thank you very much for joining us on BQ Prime. My first question to you, Mr. Goliya, you know, give me a sense of the kind of business profile that you have, what kind of work you do, and how are you going to use this proceeds of 75 crores which you are raising through the IPO?
Yeah, so you already answered your question. You said we are a global energy efficiency solution company. So we are a company which is global. We have got manufacturing facilities in Poland. We've got manufacturing facilities in China. We've got in India. We've got modification centers in USA. We've got a modification center in UK. So we are global. We work in the space of energy efficiency solutions. So first is energy efficiency. Energy has many forms. Most of it is electrical. So how to increase the efficiency? If we have to increase the efficiency, first thing we have to do is to measure the energy. So we make instruments which measure energy, and then we help people in optimizing, analyzing, recording. We take data on the cloud. Data is on the cloud. So we do many things which are helping people to increase their energy efficiency. That's one major business. The other business we have is aluminum pressure die casting. We have a facility in Poland which does melting every day. We melt about 20,000 kilos of aluminum, 20 tons of aluminum. We cast it into particular shapes depending on the end customer. We have dies for it. We do CNC machining. We do tumbling operation. We do many other operations like powder coating, painting, and giving a product which is ready to be used by the customer. So this is the main business in which we operate. And your second part of the question was, how do we use 75 crores? See, this is a company which has been growing continuously. Any of you can go through the historical data of the company. But as our country is growing so well, we see the demand is even growing faster than what we are able to grow. So from that point of view, we have to create the infrastructure. In the last 2 years, we have grown about 22-23% each year. And if we continue to grow at this rate, then obviously you need new infrastructure. So new molding machines, new spaces, new CNC machines, all these are required. So out of 75 crores, about 62 crores is supposed to be used for infrastructure development.
Sir, you're coming with an IPO which has a fresh issue of 75 crores and OFS of 415.8 crores. And the fund, global fund, which is the South Asia Clean Energy Fund, which is backed by General Electric, is exiting completely from the company as part of this IPO. What is the reason why they're exiting completely at this point in time? Because in the past we have seen only part exits by some of the equity partner or fund partners which come in early stages and invest in the companies.
Yeah, see, the point is that they have been in the company for 10 years, so they have a particular life. Normally life for such PEs is 5 to 7 years. Now, for whatever reasons, they have been in the company for 10 years, so they have reporting to be done to their to their management sitting in USA. I think that is the main reason why they want to exit completely. Also, we did not want to dilute, and there are SEBI regulations which require minimum 25% dilution. So I think these are the two main reasons. Dinesh, unless you want to add.
Yeah, absolutely, I agree.
Yeah. What is the kind of opportunity that your business can provide? Because you are into metering, you are into aluminum die casting as well. Give me a sense of the kind of opportunity that comes in with this, especially in India. Are you also into smart metering, which has now been talked about in the country? Is that the opportunity for you going forward, Mr. Musalekar? If you can come in.
Yeah, so let me talk to you about the market size, which you touched in the first part of your question. So as we are a global company, we have got access to the market around the globe. So we have got 5 revenue streams, starting from aluminum die casting, automation, instrumentation, then digital meter, solar. So in all the 5 segment stream of revenues that we have, so the global market as we speak is around 250 billion US dollars, and this is going to grow at a CAGR of 5 to 9% globally. And that means in 5 years' time, it will reach about 400 billion. So that's the size of the market we are talking about in the products which we are. So of course, the TAM for us is about 35-40% in that. So all these details are listed in our RHP. So similarly, in India, the current market size for these product streams is about 11 billion US dollars, which will be reaching about 17 billion with a CAGR of around 6 to 10%. So our India growth rate is about 1 or 2% higher than what is the global average. So we are in a market which is substantially big and growing at 5 to 10% CAGR. And what we have is a small portion of that market size. So the opportunities are tremendous. So in fact, our growth is limited by how much we plan. So last, as Mr. Goliya said, our growth has been 22 to 23% in the last 2 years post-COVID. So we have the same kind of you can imagine that we are on the growth rate. So this will continue to happen. So when it comes to smart metering, see one segment of the product that we have. So we started with analog panel meters, then they become digital. Now all the meters are becoming smart. So with smart meter, we talk about energy, not only in energy, in every product that we have, whether it is a digital meter, power quality analyzer, some transducers, all of them become smart. Smart in the sense that you have got ability that these products can have different protocols based on where they are going, whether in an industrial application or a building automation application. So they have got different protocols like we call them like backnet and profinet and Modbus. So these are different protocols. These are like different languages that we have. So they put all this data onto what we call as a cloud, or with the MQTT technology, it goes onto the cloud where all this information is there. Then you use that information for various purpose, whether to give a closed loop system for something to operate with this data, or this data is available for people who are running factories or maintaining buildings, etc. Now coming specific to energy, so we have meters which we call as a MID meter. So this is quite globally which we supply. So where the charging of subtenants is done with this MID meters from the main meter. So we are already into that. So the technology and the know-how, all that we have. So per se, when we call about these energy meters, which we say in for domestic purposes, so that technology is all there. So at the moment we are not there, but there's a possibility that we can get into that directly, or as a OEM supplier to people who make those meters. That's always a possibility. Yeah, of course, we have all the technology know-how and we are into that space already.
How does it work in terms of expansion of your footprint? Because currently, if I'm not wrong, nearly 66% of your revenues come from overseas, and you see a big opportunity in the domestic market. So how this revenues split is going to change going forward? Do you see a lot of growth coming from domestic market, and within the domestic market, do you see this smart solutions or energy saving efficiency solutions are driving growth for you going forward?
Yeah, absolutely. See, if you look at, even though if you look at current pie, about 66 or 2/3 of the business is overseas, but you should also appreciate that about 10 years ago, Lumel, Rishabh turnover was about 100 crores and there was acquisition. So we bought this company in Poland, which was around 150 crores then. That has grown to close to 400. Rishabh has grown close to 190 crores. So there has been a growth. So that growth which has come is by acquisition and inorganic growth and development of that. So India also we have been growing. And of course, there's a lot of infrastructure projects which are happening in India, smart cities, railways, Vande Bharat, and new buildings. And so there is a lot of scope in the new infrastructure which is going to happen. And as energy is becoming more and more expensive, so people have this drive, not only in India, globally, to save energy, to measure energy, to look at the quality of energy. So this is already in place, and so we also are coming up with a lot of solar farms. So this is called as a distributed energy sources. So you've got small energy sources like whether it is windmill or solar farms or hydro energy. So when the energy is produced, so you have to put on the common grid, which is common for the country. Before you put this on the grid, you have to ensure that this power which is generated is absolutely good in terms of its purity, or it is not polluted. So your frequency, harmonics, and all those things have to be checked, monitored, and corrected. So a lot of our products are in that domain, so which will really help us to grow the business. So we see a bright future in terms of direction in which the technology is going, in the size in which the market is growing. So we are really, really very optimistic.
Just to add to what Dinesh said, see, there is both organic and inorganic. What has happened in the last few years, our growth, we have acquired a lot of companies abroad. Lumal was a company we acquired in Poland. There was a company V&A we acquired in China. There was a business we acquired in UK. It's called Sea Farm and Tinsley. So a lot of acquisition, but these were not by design. These just happened. See, you keep on looking at growth opportunities. Wherever you get business, you do it. At the moment, we will be looking both in India and abroad, but both organic and inorganic also. There's a very healthy competition where all the three major companies, the Lumal Electric, the Lumal Aluminium, and the Rishabh, they all compete on growth, on EBITDA, on all these. So we don't try to pull down anybody or pull up anybody. Whatever comes naturally comes. So today you find 2/3, 1/3. 1/3 is in India, 2/3 is outside. But I'm sure going ahead, this could change. I don't know which way. It could change positive way. I mean, not positive, but it could change in favor of India. It could change in favor of foreign businesses. Mm-hmm. So we let companies grow as they are growing, and we manage growth.
Give me a sense of kind of EBITDA margins these businesses have, your segmental businesses, whether it's aluminum die casting or energy efficiency solution business. What kind of margins they work on?
Yeah. See, generally there is a perception, it is true also, that normally aluminum die casting business are with the EBITDA 9 to 11, 12% is what you normally see in the industry. But we are around, in a longer horizon, we are around 17 to 19% EBITDA. This happens because we just not do the aluminum die casting itself, but we also do machining and a lot of post-process value addition, and there's a forward integration, a lot of things we do. So our margins are much better there. And also we supply very high precision machine parts to auto industry. So where our products go into, safety related equipments like in a braking system or in seat belts safeties or airbag safeties or compressors, air conditioning compressor where the temperature is like 300 degrees inside those products. So that gives us really a niche market, and our margins are much better there. So we talk about EBITDA 17-18%, similar to electronics business. Electronic business also are similar to that. We see a lot of potential because we have a lot of backward integration. So
for EBITDA, your EBITDAs for electronics must be much lower, right? Because if I'm not wrong, for FY23 you had an EBITDA of margin of 13.4%, and it declined compared to FY22. Profit was flat in FY23 and FY20 over FY22. So I was wondering what kind of margin profiles are you working on?
Yeah, so FY23 was very typical because, as you know, that we had post-COVID, we had a big crisis of the component prices and component availability. So that's the main reason where the material cost of electronic components went up substantially. We were not able to transfer all of that to our customer, which subsequently happened, and they changed direction. So that was one reason. And secondly, energy costs were also very high because our plant for aluminum die casting is in Poland, and when the Ukraine war started, they were dependent on Russian gas, so it had some effect. Now all that is streamlined. The gas prices and electricity prices are also coming down. There were a couple of reasons which were there. Apart from that, we also had this, pre-IPO, there were ESOPs given to all the key people in the company. So that cost also has come in. Then we had to have consolidation of all our accounts, and Forex, which is unrealized kind of a thing for our businesses in Poland and Europe, were to be consolidated. So we had some couple of you can say non-operational, non-notional expenses going in there. If we do the adjustments for them, then we have it is not flat. We have in the absolute number more profits than 22. So
what? Yeah, Mr. Goliya, you want to add?
There were very good years when we had EBITDA in the electrical business 22-23%. As Dinesh just explained to you, COVID did upset a lot of things. Absolutely, semiconductor business went into a tailspin. But I think things are back to normal, so we should hopefully come back to our earlier EBITDA.
Are you heavily dependent on semiconductor component for your energy business?
Electrical, yeah. For electrical businesses, of course, there's a lot of electronics which goes into these products, and like every electronic manufacturer, so we are dependent on components. Actually, the components, most of the components were available. The only problem was with the ICs. So these ICs, we were dependent on China, Taiwan, and the whole world is dependent on that. So that's where, but now what is happening is semiconductor manufacturing is a big investment which all the governments, including Indian government and European governments, US governments are doing, and the dependence on China for the ICs is going to go down in the future. So there's a lot of this work which is happening, and billions of euros and dollars are being spent by government as well as private sector to increase this market.
Are you also looking at alternative supply chain resources?
So of course, to mitigate the business risk, we always try to have alternate supplies, and also to mitigate risk, we are developing our products not based on only one particular chip. So to develop the product with multiple chips or ICs. So if one IC is not available, the second one which is available could be taken. In fact, we did a lot of work on this during COVID period when ICs were not available. Our R&Ds. This is where we have advantage because we have our own R&D and we have our own engineers who can our own products, design products. We are not like just manufacturing for somebody else. So our R&D engineers were able to design products with ICs which are easily available in the market. So we could manage our business much better than our competition during this period, and we'll continue to do that. So diversification with the product, with supply chain, we always do that. So normally 70-30, we keep all the key components. We have one supplier who can supply 70%, the other supplier who can supply 30%, so that if something goes wrong with one supplier, the other supplier is always there.
See, as Dinesh explained, the world has realized, in COVID, COVID has taught us many things, but one of the things it taught us was how dependent we are on silicon and how we are dependent on ICs. And therefore, although there was a sort of not monopoly, not duopoly, but probably triopoly, where there were 3-4 countries in the world making ICs, today many other countries have started looking at it. India has declared a big fillip. If somebody, private sector wants to come, India government will support it. So I'm sure in the next 3-4, and anyway, everybody knows electronics has become a part of our lives. In India also, the biggest import content was petrol and petroleum products, and now it has changed to electronic and electronic products. So government of India has realized that there should be more local production. Government is putting a lot of resources. It's instigating people to set up fabrication. It's called fab, fabrication units. We are already leading company in designing. So we have committed 600,000 people to this industry. And I'm sure in the coming years, we will more depend on indigenous sources than imported sources.
Give me a sense of two critical things. One is the gas availability, which impacted you post the Russia-Ukraine war. Has it stabilized and the prices stabilized, gone back to pre-war? And the second one is on the cost of supply chain. Has it again gone back to the normal or is still there? And will these two help you improve your margins in, say, FY24 going forward?
Yeah, absolutely. First question is about the gas prices. So when the war broke out, there was a lot of speculation. People didn't know how long it is going to last, what is going to happen, etc., etc. But see, our biggest consumption of gas is in Poland in our aluminum die casting. So Europe, being Europe, so they had their own alternate mechanism to take care of that. and moreover the plant where we are. So we are dependent on the gas which is produced about 100 kilometers from where the plant is. Our plant is in Zelenogora. The gas is actually produced from 100 kilometers from there, and we are supplied with that. But because of the it cannot be at differential prices, so that price has to be in comparison in line with the rest of Poland and rest of Europe. So the price went up. Now so availability is not an issue. The prices now, see, they became 5 times more expensive overnight. Now they have come back, but they are not like at the first level, but they are, say, about 2 times or 2.5 times more expensive than the pre-war this thing. But during this period, all this price we were able to transfer to our suppliers. So that's why in 2023 we were not able to transfer this immediately. So we had to engage with all our big suppliers because they were all big customers. So with the big customers, we have to engage and then make the amendments to the contract, and new contracts we are taking with the energy indexation. So we book the order with some energy price. So if the prices go up in the energy, then we have a right to adjust those prices. This is how the contracts we have been assigning. So that has been mitigated. And coming back to, and we see those results coming through after making all those adjustments on the profit side. I do not want to talk about the current profits because SEBI doesn't allow us to talk about those things. But on the electronic material side also, so the prices, like I'll give you some examples. Few ICs which had become so expensive, from $5 they had become $100. They have come back to say $10. They have not become 5. But again, all these price increases we are able to transfer to our customers, and our price corrections were done. So we are very much in control, and I don't see any problems in that being that was a big problem in 2023. We learned some lessons and we did corrections, and now going forward we will not have any problems. We will be if something extremely extraordinary happens, then we don't know. But with these two issues, we have the solutions and which are already implemented.
So, what is the kind of lag period with which it comes into effect to get an understanding of it? So, if there was a price escalation in FY23, what is the lag with which you pass on to the customer and it gets reflected in your financials?
So in electrical business, it is relatively faster. When everything was stable, we used to do price corrections once in a year. Now we do multiple times, like 3 to 4 times in a year, based on different product group category. Wherever the product, which products we are using, and customers also understand that, because all our clients, customers are long-term customers, so we don't have. We work more like a partnership, so they understand that. So for electrical business, I would say it's about 3 months. For aluminum die casting, before it took about 6 months to 1 year for us to implement. Now with price indexation, every 3 months we can do that. But in Europe, we can book energy, both gas as well as electricity, for 1 year in advance, for the whole year with the price. So we build that in the price correction at the beginning of the year. So Jan to December, we can book the energy price. So we know exactly how much is the energy. We have indexation formula, and we can build and do that. So that's kind of fixed for good now.
So with all these things coming into play and your new contracts coming into play, will you be able to go back to about the 2022 EBITDA margins of 15.5%?
More than that.
Okay. Finally, sir, you are going to use this money for expansion at the Nashik manufacturing facility. What kind of facility is it, and what kind of potential that it has in terms of production and revenue?
See, currently our Nashik facility, there are, if you look at our products, we have got majority of products. One is digital products, the other one is analog products. When we have analog products, we talk about current transformers, analog panel meters, switches, etc. So we have got kind of 2 plants there. One will be focused on analog production, where we have 50% capacity to grow. And the other side, where we make, again, we make molds for making the plastic housings, etc. There we have to expand a little bit. And then we have got electronics manufacturing. In the electronics manufacturing, we have got SMT lines. So there we have to expand. So that's where about 62 crores of investment is going to happen. So we see a huge market potential. I talked about the market size, all that is there. The only thing is that we want to moderate our growth to 20 to 25% between that. So that's to ensure that we deliver on time, we deliver quality, we have trained manpower to support this, and management bandwidth grows. So we want to scale our growth to that effect. That's how the company's philosophy, and we want to grow that way.
Mr. Goliya, by when do you expect this Nasik plant to be operational? After
The
the
whole
capex, after the capex.
after the capex is also building portion. So the building portion itself will take about 15 months. Right, from designing the building to getting all the approvals, to fire approvals, to construction, to certification, to buying the machinery. So you can say end of the coming year. We are in 23, end of 24, we should have it fully functional.
Yeah, and it's more like a brownfield. So we have full operations going on there, factory operations. It will be expansion of the existing facility with the additional building and manufacturing equipments.
Gentlemen, it was a pleasure talking to you today. Thank you very much for joining us. Rishabh Instruments IPO opens on August 30th and closes on September 1st. Price between 418 to 441. It has a fresh issue of 75 crores and OFS of 415.8 crores, where the existing investor South Asia Clean Energy Fund is exiting. And the IPO opens on August 30, giving the company a market value of over 1,600 crores at the upper end of the price band. Thank you for joining us on IPO Adda.